Hey everybody, happy Wednesday morning. It's 8:30 a.m. beach time here in Los Angeles. This is Gil coming at you on what is actually a pretty nice day here out on the beach. Anyways, Dr. K, you there?
Yeah, I'm here.
Okay, Billy, you're there in the background, I'm assuming. Okay, what do we got going on here? We got the market running into resistance on the NASDAQ at the 200-day moving average. We're starting to come off. What's the volume rate running at right now, Dr. K?
Let me check that. It looks, when I checked earlier, it looked like today could very well be a distribution day, another distribution day.
Yeah, it looks like volume's up on the NASDAQ and it's down right now on the NYSE, but not by much. When you see the volume changes -8 to 10%, 5%, I think a lot of that can change by the end of the day. And of course, maybe the indexes can change direction in the middle of the day. However, the underlying action is not all that great. I know we get some emails from people talking about stocks like Nuance, NUAN, which is a thin little tech stock, and some other smaller stocks that are acting okay. But to us, I think that the real story here is in the action of the leaders, the big leaders, and what they've been doing. And a lot of them are breaking down here. So we have another one today, Amazon, which is getting Netflix today. That's a new term when you have a stock breakdown like that on earnings. We call it Netflix. That's a pretty brutal drop. But so anyways, you've got volume picking up here. So we're at a critical juncture here. And what I actually find myself for my own trading is that I'm up about 7-8% today on the short side and going to new highs since I started going short about 4, 5, 6 weeks ago. I'm actually finding that to be the much more profitable side of this market, which is kind of bizarre. Particularly when supposedly you have had a follow-through day last week and everything is moving along like a new rally phase, but it doesn't seem to strike me that that's the case. Dr. K, got any light to shed on my comments?
It's very much like March of 2009, where the indices went straight up, but it was led by junk. And the leaders were lagging severely in 2009, which made 2009, as William O'Neill himself put it, the most challenging year of his 50-year career. Now, what we're seeing this month in October is a straight off the bottom action again by the indices, yet the leaders are stumbling all over the place. I think that speaks to quantitative easing out of the Fed and also out of the ECB. And I think perhaps they might be trying to cushion any kind of turbulence if Germany and France can't come to some sort of agreement that is palatable to all parties. In fact, it's probably unlikely that they're going to reach that sort of agreement. I think there are going to be parties involved that are going to be quite upset, and the market probably is going to. We're going to see what the market does, but I wouldn't be surprised to see the model push into a sell signal situation simply because the market is not happy with the deal that is reached here in Europe.
Yeah, I think the underlying action in the market tells you that the best way to approach the market right now is as a market of stocks, and you're looking at each opportunity or potential opportunity on the basis of its own merits alone. And there is a basic theme here that as the market's running up, you're seeing more leaders top. And of course, with Amazon today breaking down on a big gap down move, looks like it's heading to undercut this low here, which is a 200.43 low here. So you undercut earlier. I think you're probably headed for the 200-day moving average. But I also think this could break down very fast, mainly because what you have here is this big, you have this 2 weeks down and 2 weeks up after a long run. So that's actually a topping signal. So I actually felt I could have gotten short Amazon into the earnings yesterday, but I'm not really into playing that because the bottom line is, yeah, if you had shorted Amazon yesterday into earnings, you'd be up 20 bucks or so. That's about 10%. But the key is to make big money on the short side. That's nice on an intraday basis if you can pick that trade off. And right now I am short Amazon using the high of today of 207 as a stop. You notice it came right up in here, which looked like a congestion area this morning after moving lower after hours yesterday. And so it may, we'll see if that holds, but I would be looking for this to move sharply lower on the basis of the 2 down, 2 up top. You see that? I mean, that, in this case, that's a pretty clear 2 down, 2 weeks down, 2 weeks up, which is an old rule that O'Neill taught us that can tell you a stock that's had a big run has topped out, and so that's why you definitely won't want to be buying that pattern. But I think Amazon's topped for now, just like I think Apple's probably topped for now. And we'll see how those stocks pan out over the next few days. But you're at a critical juncture here where you're going to see what the Eurocrats, or whatever they're called these days, all decide to do with respect to how much ink they're going to put into their printing presses, whether they're going to use blue ink or black ink, or whether they're going to print on toilet paper or use just cheap notebook paper. And so as they work that out and hit the wires with various news headlines, you do get some volatility. But I think the underlying tone of the market to me is very negative here. And when I can make more money on the short side, even on days when the market's up big, I think that tells you something. Okay, so here's what I'm looking for here on Amazon. You're going to undercut this low. You already tried to undercut it. You're trying to rally up through it now. But it could end up a lot like GMCR. Whoops. Where did that comma come from? Where you undercut this low here, okay, and that looks like you're going to try and rally, but it just gets a little blip to the upside, and then boom, it breaks down again. And it's shortable on this rally up into the 200-day moving average. So the other day we talked about this, and I don't know if some of you were able to get short here, but I'm short Green Mountain here again. It's really breaking to the downside. It looks ugly as sin, but you know, where are you headed? Let's look at the weekly chart. Are you headed, you're undercutting these lows here, but that may not be enough to stop it at this point because it's got a lot of velocity. So you may be heading for maybe this low eventually, somewhere in here. I don't know if you're going to come in here and try to bounce at some point. It's probably going to depend on the general market. But this thing looks like death warmed over. And for now, I'm just playing this as a short, using the high of each day as a trailing stop, depending on how the stock acts. It's a little bit a fluid situation in terms of deciding whether to stay with the position for more of a gainer if you're going to try and trade it on a short-term basis, hoping that it's going to bounce. But you're not 100% guaranteed of that. So if you're looking to make big money, like you could have if you just shorted Netflix way back when we talked about it here and just hung with it, you have this bearish flag formation. The one thing I didn't like about this is it was sort of drifting down. It had a little bit of a look of a reverse head and shoulders. I thought maybe you'd get a rally on earnings, but that was not to be, as the thing just blew apart here. Huge volume. This thing's probably going lower. And a couple of weeks ago, I think, actually maybe a month or so ago, I predicted it'll get to 40 bucks before it finally maybe gets bought out by somebody. But it looks pretty grim right here. This is more like a dead cat splat. You're not getting any bounce at all. And I would even think you could try and short Netflix here if you're real aggressive and you want to play the momentum on the downside here using the high at 78.85 today as a stop. I mean, that's an aggressive trading strategy, but I think it could be feasible. Just like I think coming after Apple here, it's trying to hold the 20-day, but if it gets through the 50-day, right now holding the 400 level on the downside, I think if it can't get above that, it's probably going to break down through the 50-day moving average. And the thing with shorting stocks like Amazon and Apple is that you're also betting against the NASDAQ 100 for the most part. So to me, it's kind of a juiced-up NASDAQ 100 trade if you're trying to short Apple or Amazon on the basis that they might be late-stage failed basis. Okay? So that's what I'm looking at as far as the short side on those. Baidu comes out with earnings on Thursday. I notice on this pattern, and for those of you who like to play options, you might want to try this one into earnings on Thursday. And if you can buy a pretty reasonably priced put going into earnings where your upside or downside risk on an upside move is minimal, I think it's probably playable. And the reason why is I think this whole pattern has got problems. And you're seeing the 50-day moving average now breaking below the 200-day. So that's a black cross. And when you have these patterns, here's Baidu's weekly chart. And you can see you got the left shoulder, and here's the head, and the right shoulder forward here. So you're right at the peak of the right shoulder. So a lot of times, and you know, this was one of the flaws that I felt was in the book, How to Make Money Selling Stocks Short, that I wrote with O'Neill. We didn't show daily charts. And to me, daily charts are really the heart of the matter. It's where the rubber meets the road because that's where you're going to be trading on a daily basis. And a lot of the moves that you see where stocks break down, like let's say Netflix, for example, where stocks break down, here's your head and shoulders, there's your neckline coming through here, okay? So a lot of these moves, that looks like a nice, clean, you know, breakdown and breakout. You could be shorting it in here, you know, or anywhere in here, but that's not really the case because the weekly chart doesn't show you the gap down. And a lot of times, moves to the downside, serious moves to the downside, occur after there's a breakdown through a neckline or through a key moving average on huge volume, and a lot of times those will occur on news, earnings-related news, or some other business-related news, such as we saw with Green Mountain. And when you see the news hit the stock like that, and that volume comes in on the sell side, that's telling you to get short that thing. And at that point, there's just too much downside velocity, and then you play it for the big move. So I think you may have a lot more room on Green Mountain to the downside. You're in an area where you could undercut and start to rally. I think a lot of that depends on the on the market today. So I don't know if Green Mountain is off. I'm looking at Baidu after the close on Thursday. I don't think Green Mountain announces earnings until December. Anybody have a beat on that? Dr. K, do you know when they announce earnings? My understanding was...
well, according to one, it's 12/9, December 9th.
Yes, but you can't trust that. Let's see. According to Briefing.com, Briefing.com says November 9th after market. So they're coming out not till November. So there's really nothing here to worry about in terms of a news push. But, it looks to me like no matter what happens, this could end up like Netflix. It just goes straight down, almost in a straight line, at least in the weekly chart. So let's go through a couple other names I'm looking at on the short side. Also, I think Baidu, like I said, you want to try Baidu. I think it's doable using options. If you're really bold, you can do a smaller straight position with stocks. But you're using this, the 132 high at the 50-day as your stop. So a couple of stocks real quick that we got stopped out of. And Fossil, we're getting stopped out of coming up through the 50-day and also the 65-day. You notice the 65-day exponential, the black line, had served as pretty good resistance. Recently it's come up, but these guys come out with earnings in a week or so, and I'll bet you that's going to be when it finally breaks, if it does. But the retail group has been a little bit stronger than the rest of the market, so not necessarily clear to me that you'll see a lot of blow-ups. It seems like it's in the big leaders like Amazon and Apple. I wouldn't use a breach. Somebody's asking whether you would use a 200-day or $200 price breach as a reason to short Amazon. I don't think so, because this is a low here, 243. It could undercut, or it could head for the 200-day. I think you're already short at using the high of the day, and you're testing it here. Because if the bounce is weak from here, then this thing probably is headed for this low down at around 177.10. That's what I'm kind of looking for. So I'm kind of going for broke here. Either it's going to go through the 200-day, or I'm going to get stopped out up here, and that's basically the situation there. But that's what you have here is you have this 2 weeks down, remember, and 2 weeks up. So that's a sell signal right there if you're long the stock. Now with the breakdown, and you have this big gap down move on massive volume, it's already telling you that, or it's telling you that this thing is going to move lower. So, but we'll see what happens. Stay fluid here. I may end up covering all my shorts by the close. I may end up covering all my shorts in the next 10 minutes, so it really depends. If I'm up big on the day, I may protect some of my profits and just back away and see how all these things pan out. Or not be so heavy, because right now I'm running over 300% short. So, so unless you can deal with a lot of volatility, I don't recommend doing that. So let's see, we went through those stocks. Yahoo Finance says they have earnings today. Okay, well, I'm not quite sure if that's true or not. We'll have to double check on that. Will you short Win at this point? Well, I guess I can let you guys know that I did short it this morning because you got the 20-day. See how it breaks down? So you have the big gap down, but this thing's already looking like something of a, I don't know, it's kind of a head and shoulders, but I kind of look at it as a failed cup with handle. Breakout attempt. This is a faulty handle. It's kind of a deep pattern. It's got a little bit of that pod look because it's so deep. And it tries to break out, and it comes straight down, and you rally back up in the 200-day or the 40-week on the weekly. That's what we're looking at here. Let's fatten this up a little bit. Notice the 10-week, the 50-day is crossed below the 40-week or the 200-day. And notice that once that happens, that's when you get the break off of here. Now you're stalling up here right around the 20-day moving average. So, I shorted up into the 128 or 127 area this morning. It's sitting there. It looks pretty fat, and earnings have already come out, so I don't have to mess with that. So, so we'll see what happens with that. But that looks shortable to me. I think that one's weakening. LVS is one that's been really squirrely. But you notice the patterns are a little bit different, so you might look at that one also on the same premise. But stick to your stops if you go short anything, because if there's some announcement that the Italians have decided to make love to the French, who are going to make love to the Germans in a bizarre financial three-way, then you might get some kind of strange rally in the market. I think you're subject to a lot of that. But so far so good on the short side. I'm not complaining, I'll tell you that much. Priceline is one that stopped you out at the 50-day. But see, here's an example. You get stopped out real quick and it rolls over. You could be back on the short side on this, using either the high of today or the 50-day or even the 200-day here if you want to get real tight with your stops. And I think that's potentially doable. The only problem is I think Priceline comes out with earnings either this week or next week, so they're going to be a sensitive name, or an earnings-sensitive name to be short. So I think there are other stocks I'd rather play. Those would be the ones that have already come out with earnings. Now, let's see, what was I going to say about it? Getting back to Apple. Okay, some are asking, do you use the 400 level as a trailing stop? Right now I'm using that as my trailing stop for a short position that I have. So we'll see how that pans out. But it doesn't have to necessarily break right away. It could bounce along here for a while. You're also noticing that the volume, I don't think, is really that heavy today. In fact, it's 11% below average. So it may try and hold. So that's a possibility. But we're kind of watching that. I think Amazon is the weaker one and the more vulnerable one here. But it's also at a logical place where it might try and bounce a little bit. So, but I think the big money here to be made was in Green Mountain, if you were all over that. And you're seeing some of the Chinese internets also. Baidu is looking weak. And Sina coming out hard today after running into resistance at the. You notice how the 65-day exponential and the 50-day are kind of running together. It's finding resistance there. So any of these targets, and we're only dealing with a very small number of them right now. And the key is, the whole point with shorting is that I'll be working 5 to 10 stocks, but slowly as I go along, one after the other of the stronger ones will just knock me out. And I'll stay out of them, and what I end up doing is getting into the weaker ones like GMCR. And all you need is one of these to really make some big money on the upside shorting the market. So why isn't Amazon a liquidity crush? It's a big gap down off the peak. If you have a liquidity crush, that usually occurs after stock's been in a downtrend for a while. You guys are trying to apply really simplistic approach to some of these rules. If you have a big break off the peak on huge volume, that's a liquidity crush. Give me a break. That's telling you the stock's in trouble after you have a 2 down and 2 up sell signal. So, I would say once you see something in a downtrend for either several days or several weeks, and suddenly you see a big gap down on huge volume, that's a liquidity crush. I'm not interested in shorting Xilinx. Everybody throws all kinds of short sale ideas at me, and the bottom line is, I'm sticking to a small handful of stocks. It keeps things simpler. It allows me to be able to sort through them. They're all major leaders. Xilinx, would I short? No, not really. I don't know. To me, it's not a big leader. Did it have some massive big move? I don't know. Did it? Not really. It wasn't the big leader. You go after the things that everybody gets into. The Netflixes, the Amazons, the Green Mountains, those sorts of things. Priceline earnings are on November 7th, someone tells us. So, what is Dr. K doing in this market? Why, we don't tell you what we're doing in the market. I'll tell you if I'm shorting, but that's not our job. None of your business. I will tell you this much. Dr. K and I run our retirement money jointly, okay? And we are up as of the end of September, because we don't have the published results for October yet. We were up 56.51% year to date, and that's our IRA accounts. Okay, that's the one audited account I have. My other trading accounts are crazy, and money's flying in and out, and they're all over the place. But doing very well lately on the short side. So we'll go with the slow account and just let you know that that's up 56.51% because we know that's a reviewed number and will be audited at year end by Rothstein Cass. So that's the number we'll use. It also tells you, the way we operate with that money, we're using the model strictly. And even though you can get these big gains supposedly with the model by being short the TNA in August, 100 some %, from the practical side, I think the way we run our own retirement money, using the model and using ETFs, and occasionally using a big stock or two, that really is the test of the model in real time with real money in a real market. So, not a bad number in a year when most people are floundering. So. Well, you're asking us if we're looking at anything on the long side, and I would ask you, is your email system working? You know, we talked about iSurge, you know, Intuitive Surgical. It's a Bible gap up, and it was Bible here. It never closed below the low if you're allowing for little porosity. It's still holding up. Okay, so that's Bible if you want to go long. Chipotle Mexican Grill, we told you about the pocket pivot here, and it's moved up, and now it's pulling back. Okay. So, you know, you could look at that. And my view is if you're going to play the long side, then it's going to be kind of a QE rally. They're going to push big index stocks probably. And I don't see why, if you want to you want to go long the market, you know, go with the best names out there on the long side, the biggest stocks. Those will probably be the ones that get pushed up, especially if they have favorable earnings. I mean, that's a nice big volume spike on CMG. So, you know, but we put out those alerts. So QCore, Questcor is a pharmaceutical company we've liked. Bible Gap, Dr. K?
Yeah, it is a viable gap up. I mean, the stock has had a tremendous run, showing a lot of leadership. It actually had three prior gap ups. The first one in early April, which was a viable gap up. And then the one in July was also viable, but then the market came under a lot of weakness, so it dragged down the stock. Now, if the market's going to continue higher, certainly the stock should be able to outperform as it did back in April. But keep in mind that the model is on a neutral signal, and it's a very news-driven market. So I would position size carefully if you're going to be on the long side in this environment.
Yeah, and just to let you know that, you know, sometimes things don't always work so perfectly. I was buying a little bit of this when it was pulling back into the 10-day on the basis of these pocket pivots. You're seeing these kind of pocket pivot moves in here, and I think we alerted you to one of them in here. I forget where, but you know, I sold it before earnings came out just because I didn't really like the tone of the market, and of course, you know, gaps up. So life is not perfect, but we're finding other ways to play the market. So. LinkedIn, someone's asking, am I still in it? You know, I don't know, unless I want to tell you, it's really none of your business whether I'm in it or not. Would you be in it? You know, I don't know. The market's kind of funky. You get a pocket pivot through here, you get a nice little trade on this, but you're going into earnings, so I'm not really excited about owning anything going into earnings necessarily. But it is holding this nice little move. I would say just wait till earnings come out and see if it gaps up and then go into it. That seems to be the lowest risk spot. You know, I don't know if you're going to try and buy coming in here. I suppose you could do it. So, but whether I'm in it or not is kind of irrelevant. I mean, why would I waste my time with money in LinkedIn going sideways when I can just be short the hell out of Green Mountain? Hello? Hello? Some of you guys don't really understand that aspect of trading either, but that's how you put up big numbers. You know, you go after what's moving and what's going to make you money. I'll try and refrain from using that word, but I'll say not diddling around with stocks going sideways and hoping that they're going to have a good earnings announcement. Come on, give me a break.
Also, LinkedIn is a small cap name. It's an IPO, and this market environment is quite unkind to that type of stock. Someone wanted to know about FIO. It had a gap up, and it's got a great story behind it, and they wanted to know if it's viable. And we didn't put a report out on it simply because it is a thin stock. It came straight up off the bottom, and it's better in this environment to steer clear of that kind of name. Now, that said, it is issuing another pocket pivot point today, so you know, for the bold, they could potentially pyramid into this stock in a gentle manner, keeping in mind.
You're talking about FIO, Dr. K?
Yeah, FIO.
Yeah. Just want to make sure I got the right chart up there. Wish I could trade your arrogance. Yeah. So do I. But I can't. I can only just just so you know, Don, there's those who know me well will always say, oh, you can always tell when Gil's making big money in the market. He gets really obnoxious. My kids call it my Archie Bunker face. But you know, I think I'll tell you what annoys me. Okay, why do people ask us, what are you doing in your account? Do you still hold this? Do you still hold that? What do you care? Take the information we provide, use it in your own account. You know, trade it. Learn how to use it. It's like, how do you know if I own something or Dr. K owns something that we don't have a 5% position or that we have a 200% position? How do you know? You know, and why does that matter? We could be really wrong. You know, and so I just think that whole attitude of having to know what other people are doing is really silly. And O'Neill used to get on our case big time about talking to each other and telling each other what we had. Dr. K and I, we used to talk about the market every day when we worked at O'Neill, but we never told each other what we were trading or what we owned, okay? And we still really don't do that today in our personal accounts. I mean, I talk to Dr. K probably less during a day than some of you email us. So, you know, there's no need to be wondering what everybody else is doing and what are your trades and what are you holding, and you know. And O'Neill would get on our case if he caught us doing that.
And if
so
you try to trade with someone else's volatility, and everyone's got different risk-reward characteristics to their trading. It's like a fingerprint. And so if your fingerprint doesn't match theirs or doesn't even come close to matching theirs, and you try to trade like them, it's going to be a problem for your own account. And you're probably going to end up losing money, even though they might end up making money, simply because the volatility characteristics are not part of your trading personality.
Exactly. So anyways, that's my point. So I like this question. Now this is the kind of question I would like to see more of. What kind of toilet paper do you use? Charmin, and I double it up just to get an extra absorbency. Gil, you need to be drinking during these webinars. How do you know I'm not? Mimosas in the morning can be a good thing when you're 400% short, let me tell you. Don't disclose should be a trading rule. I agree. Bill O'Neill used to say, I remember, okay, when I first started working for the guy, and this is like late 98, we're long Schwab and AOL and all these wonderful stocks going up, and I called him up and I was all excited and telling him, you know, oh, Schwab's doing this and I'm making this, and he just sat there listening very quietly. And then at the end of it, when I was finished, you hear this big swooshing sound. O'Neill, whenever he thought you said something stupid, he would go like that and say, all right, don't talk about your stocks. Slams the phone down on me. and you know, he would come down on us pretty hard sometimes. So I think a lot of people who had to work for him, he really intimidated a lot of people, and they would get real defensive and kind of show animosity towards him. But yeah, Bill is what Bill is, and I guess to some extent he was a retail broker and came up the hard way through the business, and so did I, you know. So I'm pretty thick-skinned, and you know, that's just how I am. So Dr. K and I are who we are, and we work well together. So that's all we need to do. Your lack of news is saving me money. I think so too. I think you're right. We don't need to say too much. You know, we're in a neutral signal with the market model right now, the market direction model. And kind of from that perspective, we don't really see too much on a macro basis to be playing here. Now, I can come in and short stocks. Maybe there's some things you can get long too, and there's some evidence of a few stocks acting well, like the Quest 4, like the Chipotle, like the Intuitive Surgical. But that's, you know, that goes back to what we talked about last week when we sent out a short sale setup alert to everybody, and we said you can treat the market as a market of stocks, not as a stock market, because it's kind of bifurcated. It's kind of strange, and yeah, but there's money to be made. And I just find, from a practical standpoint, O'Neill would always say, okay, what's the material result? The way you prove anything, show me the material result. What is the market showing you in terms of progress? Where are you making the most progress? Well, if I'm making the most progress on the short side, is it telling me something? I'm assuming that it is. So some people are telling us they're trading some of our short recommendations on paper. I think that's a great way to learn how to short, and I highly recommend it. So shorting is really tough, and you'll really find out a lot about yourself. And I really think that the long side can bring out your weaknesses, but the short side can really bring out your weaknesses. If you get too rigid, and if you are trying to shift too much in terms of following your rules and thinking that you can kind of slide a little bit, you know, outside the boundaries of your rules, I think in short selling, that's where you'll really get punished. You'll just get smeared. Dr. K, somebody's asking, what would need to happen for the market direction model to go into a sell signal? Well, did you already talk about that?
Not today. I think I might have mentioned it in a recent report, but not a whole lot. I mean, we've got a number of distribution days, and a lot of the leaders are breaking down, so the model is not far, I can tell you that, from moving into a sell signal. I mean, it could
Yeah,
happen.
so
It could happen today, but it looks to me like the Nasdaq could very well have another distribution day today, and then tomorrow could be the sell signal. But again, I have to look at all the variables and then see. But we're not far off.
yeah, and you know, just to make note of this, we are trading heavier volume, but notice how right now you're trading about mid-range, so where you close might be a factor here. But again, you're in a strange period again. You got this QE factor where, you know, the Fed is talking about buying up mortgage-backed securities and liquefying the system that way. So they're going to get creative, so it's more QE. But the question is, if we already know that the first couple of rounds of Fed QE didn't work to, or didn't serve to improve the economy, which has only gotten worse, the market's going to kind of yawn at QE3 and say, so, but you know, you might have a short-term rally, but maybe that's shortable, and maybe we've already had it. Who knows? So I think the situation is fluid. But you know, it hasn't kept me from being aggressive on the short side, and that's mostly where I've been. So I want to go through some more names here. Let's see, there's my NASDAQ chart. We can look at the S&P 500 real quick. And yes, it's broken out here. So the one thing about the market here that I think is interesting is if you look at the NASDAQ on a daily chart, okay, and I'm going to forget about the volume, but I want you to look at this. Let's make this a little smaller. Okay. A little fatter there. Okay, there we go. So you have this big break off the peak. You're chopping sideways. You break out to a new high. Now you're starting to roll over. All right, if we go back to the top of the market in 2007, now a couple of things. This is the market top in October of 2007. The NASDAQ topped, just so you don't get confused, NASDAQ topped right in here at the very end of October, 31st of October, Halloween, I believe. And you broke down hard on your first leg down. Now this is only about 11, 12% if I recall correctly, okay? And recently we came down over 18% off the peak in August. And so the much more severe break in 2011. And now you have this choppy rally. Now notice how you start to get to new highs here. And it looks like you're going to break out through the 50-day, which really was the relevant moving average at that point. And then he just blew apart and went on another leg down. So my point is that we might be in a similar situation. Now I can just type right here. You know, where you could be doing the same thing. So it's not uncommon for the market to show a lot of strength, suck everybody in, and then roll the whole thing over big time. But a lot of it's going to depend on what happens probably with the European situation. The one difference between now and late 2007, early 2008, when you had that new leg down in that bull bear market, is that you didn't have QE in at that point. That didn't start coming until later on. So I'm not sure how that affects. And like Dr. K was saying earlier, maybe the Fed will try to cushion any downside. But the whole thing to me is just a big joke at this point. So it's just a matter of, you know, when does either some major corrective action come into play, when do the governments get their act together. I think the U.S. has a better chance over the long run than Europe does, but that's just my opinion. We'll see. You know, I think the Europeans live in a bizarre land of denial. So, all right. You know what the big story is. One of the things, you know, that might be telling you we've got some QE possibly going on is the action of precious metals, which had a bottom fishing type of pocket pivot. Now here's the deal on this one. You're below both the 50-day and the 200-day moving averages, okay? And it's occurring out of a nice little frying pan with a handle type formation. In commodities, candlestick patterns, the Japanese used to use that as a bottoming formation. And so you have this pocket pivot. It makes it pretty simple to either play either that, the SLV, or the GLD on these pocket pivots. Now the difference with the GLD, it's a little further up in its pattern, and I think if there's a movement on the basis of gold and silver as alternative currencies, then probably gold is your better play. But notice I use a 65-day exponential. This one does take you above the 65-day exponential, so I kind of look at it from my perspective.
FOSL.
We got some movement on FOSL. Is it tanking? We'll get to that in a second here. Let's put that up here. Nope, it's moving higher. Glad I'm not shorted. So that's why you stick to your stops. But anyways, GLD, Here you could probably buy into this pocket pivot and use a 65-day exponential now as your downside guide. That's a possibility. Dr. K, any comments on how you might play the metals, if at
Yeah,
all?
someone was asking that Merrill suggested that the U.S. is dangerously close to another downgrade from other credit agencies, and so if this occurs, which seems likely, do we get another shot at the precious metals? Well, yeah, absolutely. In fact, if it doesn't occur, you still have a good shot with the precious metals simply because there's a lot of QE going on from the U.S., the U.K., and the ECB. And so both SLV and GLD had pocket pivots yesterday, as we mentioned in our report, and so some members may wish to pyramid into either one, letting each ETF prove itself on a price basis before adding to their position.
We haven't really taken any positions in here. Do you watch the advanced decline line? We don't really pay a lot of attention to that. I mean, you can see we have it here. The New York is 2045 to 860, and the Nasdaq is 1434 to 942. So that's, and somebody's asking, it's improving as we move through the day. Yeah, that's true, but the day's not over yet. But I wouldn't put a lot of stock into advanced decline per se. The price volume action of the market and leading stocks is really the key. Dr. K, do you use that at all?
No, not really. It's been shown to be a bit of a faulty indicator over the many years.
Yeah. So the other thing with the Nasdaq advanced decline line is it's never made a new high, so it's never confirmed new highs in the Nasdaq index just because of the way it's calculated. NYC might be a little more reliable. One thing I do notice though is the market has been rallying. If you look at the new highs, new lows line on both the NYSE, New York Stock Exchange, and the Nasdaq exchange. They've been pretty flat. So even as the market's been rallying, you're not seeing a lot of stocks making new highs relative to stocks making new lows. So that's been another clue. But I think that's kind of evident in the price volume action of a lot of leading stocks that just continue to break down. So in a way, it just becomes another indicator. To me, all of that, trying to find more indicators. Like over the weekend, I had a great time talking to the group at the High Growth Stock Investor Conference over the weekend. And a lot of smart people there, always an impressive bunch of people, sophisticated traders, I think, more so than your average group of retail investors. But to me, there's all kinds of indicators that people use. Some guy was telling me that, why don't you should be shorting NetEase because, and remember, that was over the weekend, so that was here, because the MACD isn't confirming this move. But, what does it do? It jacks to the upside. And I think all of that speaks to the psychological need. It's something we'll be talking about in the new book, which we're going to start writing any day now. But all of this speaks to a need for certainty in the markets. And I think as traders, and one of the most important lessons that you can internalize is the fact that you must lose to win. You must be willing to make trades where you'll be stopped out and you will lose money. If you're not able to lose money, then you're never really going to get the information you need that's going to tell you where you need to go and where you're going to make money. So, I'll lose money trying to short Fossil, but that tells me, hey, blow that one off. Go this way. Okay? And I may lose money trying to short Tiffany, the same thing. It's telling me, hey, go this way. Don't go that way. So, use that information. So when I'm wrong, I try to use that information to my benefit to help weed out where I shouldn't be going or what's showing me greater strength. So, weakness begets weakness, strength begets strength. And that's pretty much the bottom line. So you want to be weeding out, and you don't have to worry about whether you're stopped out on a short. Price line pushes you out, well, price line pushes you out. You want to come back into it, you can do that. And if you're not worried about losing 2 or 3% on the flip, then it's not really a problem. But I do think that people really need to have this sort of internalized psychology that it's okay to lose money, it's okay to be wrong. You don't need 500 indicators in the quest for certainty because it does not exist. Okay. Somebody asked, what is Portfolio Simulator Dude doing? He's actually doing fine. He's in cash, and he's going to stay in cash. In our view, the market direction model is in cash, so why should Portfolio Simulator Dude be doing? In our view, what the Portfolio Simulator does, it allows beginning investors to track how we might build a portfolio in a very favorable market environment with a fat trend playing. Okay, in this environment, it's choppy and sloppy, and I don't need to be wasting my time going in and out of positions in a choppy environment trying to create some portfolio model. I think if you're a beginner right now, you could be learning how to short on the you can be learning how to short stocks, paper trading and using some of our ideas, or you could wait for the model to give a signal and then employ some ETF purchases to enact the model in your own portfolio or implement the model in your own portfolio. But I think Portfolio Simulator Dude doesn't need to start getting into it, because I know what you guys really want. You want to see what you think we're trading back and forth in our own accounts. But I can tell you, I can move so back and forth into, say, GMCR. This morning I'm not that heavy. I come in and it opens up just a pinch, and I come in on top of it and get really heavy on it. It breaks down to 60, and I cover a bunch of it and cover half of it or cover 2/3 of it. That's just the way I trade, and so I think getting into that and trying to show that in the Portfolio Simulator, a lot of you is just going to confuse. So, so Portfolio Simulators, dude, is telling you, you people who are not very sophisticated, who are beginners, and you know who you are, just wait for the market direction model, give us a sell signal or a buy signal, and then act on that using ETFs. So you don't need to. I don't think Portfolio Simulator dude needs to be in the market, because he's kind of a wimp and he's kind of a whiny kind of guy, and not quite unlike myself, but he doesn't want to deal with it. So, but he is watching and he is learning. Okay, right, Dr. K? Any thoughts on Portfolio Simulator, dude?
Yeah, no, I think it's really a good instructive way for conservative or beginning investors to get a sense of how and when to be in the market. And as I've said in prior podcasts, if you look at 2005 to 2007, you only had to be in the market about one quarter of the time each of those years, and I would have performed a lot better in my account had I just invested, I think, 3 months in 2006, 4 months in 2005, and 2 months in 2007. So it just goes to show you that being in the market all the time is probably not the best recipe for maximizing your profits.
Yeah, and we're up 56.51%. And how much of the time have we been in the market, Dr. K?
Probably, it seems like about a third of the time this year, I'd say.
Yeah, so so that's what we're trying to do there. For you maniacs like me who want to short the market and are able to do so, we're having some fun now. But I think for a beginner, it's a very difficult environment, and you're really just risking a lot of negative reinforcement in terms of getting beaten around by the market and losing confidence and stuff like that. So you're better off, I think, if you're a beginner trying to learn. And I think the person who's paper trading some of the short sale ideas, I think that's a really great way to learn how to trade. But you're not using real money. So you can do that for a little while. If you think you got it down, then start doing small amounts. Use 10% or less of your total investable assets, your portfolio or whatever you want to use. But be smart, because I can tell you I've been stupid on the short side, okay, and it cost me a lot of money, and that's really where all my big losses come from. I don't lose money on the long side really at all, small amounts, but when you're stupid on the short side, it really is magnified, okay? So I'm going to scare you all away. No, we don't look at any of those things, the trend, the tick, the talk, the whatever. We don't do any of that stuff. Some people, Dr. K, here's a question for you. We'll get your thoughtful PhD analysis of this question. During the first hour of trading, I'm thinking that the first hour or two, where did that go? The first hour contains a lot of chop and noise, therefore avoiding trading off some false signals. What do you say?
Yeah, absolutely. In fact, back in the day, this would be 1996 and first half of 1997, when I was doing different tasks for O'Neill and was not his portfolio manager as of yet. I actually didn't trade the first hour simply because of my job tasks. It didn't allow me to. I was able to start watching the market usually around 7:30 or 8 in the morning. And as we all know, that the market in Pacific time starts at 6:30. So I would miss the first hour. And 1996 was my second year of triple-digit gains. 1997 was my third year of triple-digit gains, just barely. So it just goes to show that that first hour is ripe with a lot of volatility and fake-outs. And I keep reminding myself that because obviously I'm at the market at the opening bell. But yeah, there can be a bit of noise and volatility that can whipsaw investors that are perhaps not so in tune with those possibilities?
My answer would be I don't really care what the market's doing in the first hour. I'm kind of focused on my stock ideas. So let's look at a 5-minute of the NASDAQ this morning. They gapped it up in the morning. I'm seeing some of my stocks, like the Green Mountain is moving up a little bit. I'm seeing Win moving up to the 127, 128 area. Seeing a number of stocks trying to move up into areas I thought were shortable. I came in not too far off the opening and started hitting the market and really ramping up my short positions right away. So boom, the market broke down. Now, if the market had held and turned back up, I might back away, but I got aggressive very quickly. So I'll trade in the first hour, and I don't think that necessarily is a period you need to avoid. And yes, there can be a lot of bizarre action in the first hour, sometimes in the last hour, and we've seen those bizarre last hour rallies that seem to occur out of nowhere. But I think that if you're focused on individual stocks, you don't necessarily try to outthink the market, you know. So yeah, while you can get weird action during those periods, you can also get some very clean action to short, in this case, right into. Just like you know, if you had the reverse of this, it would be good, something good to buy into. But I can show you a lot of examples on the practical side, on the empirical side, where there are some meaningful opportunities either to short a gap up early in the day within the first hour. So, you know, again, the market's not black and white. And what Dr. K says is true. Sometimes it is best to avoid the first hour if it seems kind of strange. But sometimes when it's clean, it can provide you with a nice opportunity. Somebody's asking why the webinar is muted.
Say, if you're a beginning investor, that first hour can really, you know, it can whip you around. So I would, based on my experience, I would say you probably are better off avoiding the first hour as a beginning investor. Watch the market. Certainly watch it so you can get in tune with how the market tends to trade in that first hour. But maybe make a rule for yourself that you don't put on any positions until after the first hour is done. And then as you adjust to watching that first hour and learn how the market trades early in the morning, then you can start maybe getting your feet wet.
Yeah, some people are asking why the webinar is muted. I think that's some issues that you're having on your system, because I know that people are hearing us based on the questions we're getting. Now, some people ask, how do you know when you're no longer a beginner? And I would say when you're starting to put up consistent results. You know, if you have an up year where you're up 50% or 100% in a good bull market, then I think you're getting past the beginner phase. How's that? Anyways, now 9:17, so we're at the end here. So I'm going to sum up here. You're kind of at a critical juncture. Watch for a sell signal to come in the market direction model. That's a possibility here. But I think a lot of it may be news-oriented. In the meantime, you know, we're looking at Amazon as a potential short sale here if it's unable to rally and clear this high here. Same thing with Apple here. But you know, these are in flux. I think Green Mountain is probably headed to 40. So at this point, what I'm using as a trailing stop is the high of today now. So that would be 66.35. But you know, notice this thing just continues to move lower, 57.37, just pitching to the downside. So, you know, I think that's where you want to be. The other ones are Baidu, which you know, rallies right up in here. And like I said, you might try this going into earnings, buying the puts. To me, the pattern looks like it wants to break. So I think the best way to play that if you want to game it, you know, because it would be nice, wouldn't it, to be short Amazon, you know, yesterday. It would have been nice to be short Apple before it went into earnings. And it would have been nice to be short Netflix a couple days ago. So I think a lot of these patterns, when you're seeing them break down, and you know, the evidence is there that there are some flaws in the pattern, such as Amazon. You know, I really felt like shorting Amazon yesterday, and it's really a hindsight thing. But it was on the basis of the 2 down, 2 up. You know, now this thing I think could head down lower. Watch how it acts here, because if it doesn't hold this low, then I think that you're probably heading for this low. Okay, so that's what I'm looking at there, and I think. So Baidu is also shortable on that basis, that you know, using the puts. Sina comes out with earnings later in November. This one you had to hit it up here. What other ones to look at? RAX is another one possibly to keep an eye on here. This might be the high part of a right shoulder in the pattern. You see that? This is the big dome head. So you got left shoulder, right shoulder, and now you might be at the top here. You're kind of wedging a little bit on this rally, but it would really have to break down. Probably through the lows in here. I don't know. You could short it coming into 39.28, or you could short it here using that as your stop. Okay. So there's some ideas, but I think where the juice is going to be on the next call from our side is going to be the market direction model if we go to a sell signal. So that's really where we're at. If you have any other questions, also, shouldn't forget this. Silver and gold, yeah, playable. The pocket pivots are viable. I would use gold and use a 65-day at 163.97 as my guide for a stop. How about you, Dr. K? What would you use for a quick stop on that if you wanted to buy it here?
And if I were to play this one, I would be pyramiding in slowly, which means I would buy, say, a half position. That would allow me to hold the position, even if it comes back down into the 200-day, where it might get a bounce. 200-day is pretty far from where it's at right now, so I might go in with a smaller position here, and then it's liable to be volatile simply because it's in a basing period. I don't think it's going to just shoot straight up from here. It's also right under its 50-day. So
yeah. So, and we won't, you're not going to hear a lot of noise from us while this market's kind of in this flux zone here and you're news oriented. But there are some playable situations. We've been talking about those. You've got silver and gold to play potentially here, and we're waiting for the next signal for the market direction model, which is now neutral or cash signal. Okay. All right, everybody. Thanks for listening.
One thing. The one last question was support and resistance levels. Does the MDM use SR levels on the indices? And no, it doesn't. It's really less of a factor, the support resistance levels for ETFs and indices. ETFs that are not focused ETFs like gold and silver, but more of the broad ones like QQQ and SPY. And that said, with individual stocks, SR levels can be more important. So yeah, that's basically the short answer to that.
All right, very good. All right, everyone, thanks for listening, and good luck out there. We'll see how things pan out over the next, for the remainder of the day and then tomorrow. Tomorrow will probably be important as well. All right, take care.
So long, everybody.